Good afternoon, everyone. Welcome to today's webinar, Auction Market Trading and the Market Profile Graph, featuring Tom Alexander, who is CEO of Alexander Trading. Welcome, Tom.
Hey, Tom. It's good to be here.
Glad to have you. My name is Tom Hartle. I'm CQG's Director of Product Training. I'll be your host and moderator today. Before we get started, I want to mention a few procedure items. If you have any questions during the webinar, please enter them into the Q&A section window at any time during the presentation. We'll have Tom answer them at the end. If your presentation is on full screen, you can find the Q&A in the WebEx toolbar at the top of your screen in the drop-down menu on the far right. If you're having any sound issues, please contact the host via WebEx chat. On Monday, as we are recording today's webinar, it will be posted on Monday in the events section on news.cqg.com. So now I'd like to introduce Tom. Tom has worn many hats in this industry over his 20-year career. He's worked as a stock and futures broker, owned and managed a guaranteed introducing brokerage firm. He consults to institutional firms and hedge funds, and as you can imagine, having traded for 28 years, he's traded through every panic, crash, and market mania. He is also author of the book Practical Trading Applications of Market Profile, which was published in 2006. So Tom, thank you for being here, and I'm going to turn it over to you now.
Thank you, Tom. It's a real pleasure to be here with you guys today. I appreciate those of you that are here that are in attendance. I know that we're looking at a long holiday weekend. As Tom said, I've been trading for 28 years, and I have been a CQG user for most of that time, and I want to acknowledge Tom and Becky Guilfrey, my rep, Gene O'Sullivan, Joe Ashton, a number of people at CQG that I just think are top-notch professionals, and I wanted to start with that. Okay, market profile. Now, we're going to talk about market profile today, and I'm going to show you some things that maybe you haven't seen before, maybe you haven't thought about in terms of market profile. I want to go through a little bit of the history of market profile, the conceptual basis of market profile, give some attribution to some of those that have really furthered the concept and brought it into the public eye, and then go over some of the best uses, and then I will show you one of the ways that I use the market profile graph in my trading. We're going to cover the initial milieu of market profile, and I think this is very, very important. And it's important because when market profile was first posited by Peter Stellmeyer, and I'm sure most of you are familiar with the story about Stellmeyer was on the floor, and he had been, he grew up on a farm, and there was an auction process on the farm, and from his statistics class at Berkeley, he sort of envisioned this bell curve of activity that was occurring on the floor. Now, at the point in time that Stellmeyer was conceiving of this idea, I think the CBOT manual was published in maybe 1984, 1985. So it was around that time that his ideas were put on paper. But it probably started in the late 70s, early 80s. Now, this was a period of time when trading was dramatically different than it is today. It was a period of time where and when the floor ruled. Everything went through the floor. Regardless of what you traded, it went through the floor. So the floor had a tremendous amount of information. The volume went through the floor. And it was, trading off the floor at that point in time was very, very different than it is now. But what drove market profile initially was Stellmeyer's idea to provide information that the floor had access to the off-floor trader. You didn't have real-time volume reporting then. You had to wait 24 hours to get the volume reporting from the exchanges. So there were all sorts of things that were very, very different than now. And this tool, the way the data, basically the price data that occurred during the day was formed, the letters, the TPO counts. It was designed to show the trade activity from the perspective of the floor and what happened, where you would have a range that would be established. And within that range, you would establish relative value. You would have unfair value at one extreme, unfair value at the other extreme, and then where trade was most easily facilitated was usually near the mean of the range or the mode of the range. That's not always the case, as I'm sure most of you are aware, but that was the general concept. And this was, when Stoudemire first came out with this, it was sort of posited as being a predictive tool, that if you looked at the profile today, you could get an edge, a greater than random chance at determining what would happen the next day. And also the concept was that if something happened outside of the first hour of trading, that meant that there was bigger money coming in than just the floor, and that was a directional trade. So there were some rote trades off of that general concept, or those general concepts. Now, those concepts really proved not to be valid. They had been tested, and they were tested 20 years ago, and the idea of rote trading that profile graph was thoroughly tested and proven that there really was not a whole lot of validity to it. And this gets, I'll talk more about that in a minute, but that does not diminish the fact that it was an extraordinary new way of organizing data that does provide and did provide an incredible amount of information. But it's important to realize the context in which it was initially posited and what it was then versus what it has evolved into now. Stoudemire himself, if you've heard him speak or read anything that he's written lately, he'll tell you that the old market profile concepts really are not going to be particularly helpful to you. As a matter of fact, they can be really detrimental to you. And most people still are stuck using those same concepts that were posited in the CBOT manual. So I think it's important to really think about how you're using the profile graph if you're using this as a tool. And I'll show you some specific ways, basic concepts, the way that I use it. Now the floor doesn't rule. It's the opposite of that. The floor is basically dying. We still have some floors that are active. In particular, you've got some of the New York floors, the energy markets and things like that, maybe the grains to one degree or another. But the reality is that the transparency, the access, the volume, the reporting of volume, it's instantaneous now. It's in front of us. The idea that I can sit in my office in Savannah, Georgia, and click and get an order filled in milliseconds is pretty remarkable. When I started trading the S&Ps, you had to call the pit, you had to call the floor. And that's if you had floor access. If you were trading 5 or more contracts, you could call the floor. And so it was considered just a huge advantage if you had access to the floor. So you call the floor, you get a clerk, the clerk arbs it into the pit. The pit may or may not respond quickly back depending on what was going on. So you were lucky if you got a fill in 45 seconds to a minute. Now, we freak out if the internet goes down for 2 seconds. So we have infinitely faster access and transparency. And I'm not sure that's a good thing, and we'll talk about that too, because it's dramatically changed the nature of trading and it's changed the mindset of traders. And I think that one of the ironies is that as an off-floor trader, one of the biggest benefits you have, and this fits in with the concept of the profile graph showing a dimension of time, one of the big benefits that traders, off-floor traders have, screen-based traders have, is the ability not to do anything. And that I think that because we have such immediate access and we can get immediate fills, there is a huge tendency to overtrade and to not really take advantage of the edge an off-floor trader has, which is to not trade and to be patient and let things set up. So all of these things have changed dramatically. You know, the reporting of volume, the use of volume, the floor is insignificant now compared to what it was back when this concept was initially posited by Stellmeyer. We have, as traders, you know, you can sit in your office at home and have access to extraordinary tools, your CQG, hyper-fast trading platforms. You know, the cost of trading is nothing. I mean, you know, I can remember, you know, it used to cost $50 to do a round turn in the futures, or more, or $100 to do a round turn in the futures contract. And of course, the style of trading has become this in and out style of trading that I think is counterproductive. And I don't, even if you are a day trader, intraday trader, and I trade intraday, but I don't think it's conducive to try to tick trade, twitch trade. There's just too much noise in the market. I think there's always been too much noise, but especially now with high frequency trading, because if you're trading intraday and you're not trading at certain times and trade location, you get caught up in this noise that occurs, and the high frequency trading and the book sweeps and all this stuff that goes on now, and you really don't stand a chance. All right, I want to give attribution to three people that have really built the brand of market profile. And of course, Peter Stellmeyer, everyone has heard of. Peter Stellmeyer is, in my opinion, a visionary genius. You know, I have been listening to, you know, my first conversations with Stellmeyer were back in the late 80s when I first was exposed to the profile graph. Actually, I was using CQG. It was an enablement. I asked for a trial. I hit the button, and all these funky letters came up, and I thought, what is this? Anyway, so I was put in touch with Stellmeyer, who was very gracious and would spend a lot of time with me on the phone, and then I'd hang up and I'd go, what? I had no idea what he was talking about, but I had a sense that he knew what he was talking about. It's just that I didn't understand it. I think a lot of people today still have that feeling when they listen to Stellmeyer. But his communication style aside, the man is a visionary genius, and I can recall things that he said 15 or 20 years ago about how the markets were changing and how they would change, and a lot of it has come to pass. And a lot of it had to do with how fast markets develop now, and of course that has to do with the transparency and the access to markets and the incredible volume. So Stellmeyer to this day continues to research and to further the concept that he initially started. But I don't want to put words in Peter Stellmeyer's mouth, but I think you would, if you will listen to some of his lectures, you'll see that what he's doing now is a long way away from the old concepts as initially posited in the CBOT manual. The second person I want to acknowledge is someone that you may not have heard of, a man named Don Jones. Now, Don's a friend of mine, and Don is one of these unique people that actually Don is literally a scientist. He was a physicist by training. He was a trader, ran a hedge fund for 10 or 15 years. And at one point in time, Stellmeyer, Don Jones, and Jim Dalton were all had offices in the same building on Wacker Street there in Chicago. And Don was involved in creating the data, the profile data, or the graph that became so popular as a result of Stellmeyer's promotion of the profile concept. You know, all the floor traders wanted the profile from the previous day so they'd know what was, you know, where the value areas were and you know, all that stuff. And so Don, is a programmer provided the data. He would get it from the CBOT, and to this day, Don does research, and Don doesn't get any credit, and he should get almost as much credit in my mind as Stottlemyre for moving the ball along in terms of the initial profile concept and taking that rather qualitative concept and turning it into something and proving with hypothesis that there is an inherent edge in trading this auction concept, which is really where we have gone with the market profile, you know. But Don has done just an extraordinary work, and like Stottlemyre, he still does research to this day. I'm sure all of you have heard of Jim Dalton. Jim Dalton was a contemporary of Stottlemyre's and Don Jones. All three of these people know each other and interacted with each other in various stages, in the initial stages of market profile. And Dalton gets, in my mind, his excuse me, his primary contribution to market profile is making it so incredibly popular. And I'm sure you guys are aware he's written a couple books on the topic. Excuse me. Okay, the conceptual basis, it's pretty simple. The initial conceptual basis of the profile graph is that the amount of time price stays in a given area is indicative of an amount of value. If price doesn't stay in an area very long, there's not much value there. If it stays in an area for a long time, it has value. It's that simple. So time plus price equals value. This simple concept, I think, is really as simple, as elegantly simple as it is. It's also quite profound. I don't think that you can find a more consistent, objective, practical definition of value than this. I think this is a concept that even Warren Buffett would agree with. I don't see how you can argue with it. And it's also the world's greatest reality check. The market is the market. And I don't think we've ever had a bigger test of trading methodologies and trading systems than we have had over the past 4 years. I can't tell you how many, and you guys know this, how often you hear people whining and complaining about the stock market continuing to go up. It shouldn't go up. It's not fair. It's being manipulated. Except I can show you profiles from the Dow in the 1929s and 1930s. Those of you that have CQG and have extended data can look at it yourselves. And you've got the exact same auction process in effect then that's in effect now. You know, the exogenous events that are occurring are superfluous if you are a trader or, quite frankly, if you're an investor, because the value of the market from a profile, from an auction market perspective, is determined by the participants in the auction. No ifs, ands, or buts about it. If value is migrating higher, the trend is up. If value is migrating lower, the trend is down. It's objective, it's consistent, it's stable, and it's the most robust way to view a market that you can find. Pardon me. It doesn't matter if you're trading the S&P mini, if you're trading corn, if you're trading Forex, it doesn't matter, or trading Apple stock. You can view any market in any time frame and analyze that market and determine good trade location and trade that market using the exact same concepts, using the profile graph. But really what you're doing is you're using the profile graph as a tool to help you identify the auction process and where you are in that process. Now, to carry that theme into the next theme, where we have time at price equals value, then remember we're establishing a range of relative value. Time at price equals value. Not much time, not much value. A lot of time, a lot of value. And so what we learn is, and it's very obvious very quickly if you look at a profile graph enough, that price will stay at certain areas longer than it will at certain others. It tends to move sharply away from the extremes of a given auction. And so our definition of opportunity, one definition of opportunity, the simplest, is that price away from value equals opportunity. I would posit that all trading models that work have to have this, if not explicitly, at least implicitly, as their basis. So what we're doing is we're looking at the trade facilitation process and determining by noting the relative range of value where we want to be trading. We want to be trading away from value, and then trade is either regressive back to value or it's initiative because the market has transitioned from a phase of balance into imbalance and it begins to trend. The market is always in one of two phases, balance or imbalance. And this is a process that is occurring in all degrees of time all the time. And therein lies the edge, because what we're trying to do is identify what's going on in a smaller degree auction and trade at the extremes of that smaller degree auction and have the benefit of catching the initiative move or a larger degree move from the larger auction. Now, the best use of the market profile graph is as a tool. Market profile is not a trading system. People try to make it a trading system, and you've got to get away, if you're a trader, in my strong opinion, from trying to turn things into magic. The auction process has a logical basis. There are certain precepts that are infallible about what an auction does and why it does it. The profile graph is just a tool that helps us to determine what the auction is doing at a given point in time, and it helps us to identify trade activity, whether it's an initiative move, a sharp move, or whether the market is in balance and it's just rotating around. But the market profile graph is a tool. It is not a trading system. Now, try not to use it as an end in itself. I don't think you can use it as an end in itself. People have tried to do that. I've never seen anyone succeed at doing it. And that's a lot of people get frustrated with market profile because they want it to be this binary yes, no trade system where if the market is trading above yesterday's profile, it trades 2 ticks into the value area. There's this 80% chance it's going to retrace the entire range. There's no validity to that. It doesn't work. So my admonition to you is to don't buy into magical concepts. In particular, the trading, education, and advisory industry, and this goes from the retail trade all the way to the sophisticated institutional traders. I'm constantly amazed at some of the stuff even the institutions use that I would put in the category of magic. But there is a huge market for magic, so there's always going to be magic that's being sold to us. And I will tell you, magic works extraordinarily well. Without exception, magic will make your money disappear. I'm sort of a minimalist in terms of the stuff that I use because I think if you understand the market through this auction lens, you're able to read market condition. All indicators are basically purport to give you information about market condition that you can't get from the market itself. And there are some market-generated types of indicators, some volume indicators. CQG has some wonderful volume indicators. I don't, I use very few things. I use the profile graph and a bar chart. And when you do that, first of all, you don't have to try to look at 7 different indicators and have things line up to make a trade decision. You're truly trading. You learn to trade the auction process. If you are using indicators, that's fine. I know that most people do. I understand that. Know what they are. Know what they're telling you. And if you're using an indicator and you don't know how it works or why it does what it does, that's a real warning sign that there's no magic. There's no, contrary to popular belief, there's no secrets in trading. So if we're trading with this auction market worldview, it's extraordinarily robust. I can take a newbie and spend some time with someone that is a newbie trader, and in a relatively short period of time, they can begin to understand, if they can not necessarily put it into practice, but they can begin to understand the concept behind making trade decisions and why and the basis for that. And then I have clients that are very, very sophisticated institutional traders, and if you're an institution, you can take this and you can model off of it any number of different ways. It's extraordinarily robust, and as I keep saying that over and over, but it's unique in that regard. It is an extremely stable way to view the market. It is a concept, it's a methodology, for instance, that adjusts naturally to volatility. And volatility is, sort of the holy grail of systems traders, trying to tame volatility and factor volatility into a trading system. Well, if you're trading auction market concepts, the auction is the auction, whether the S&P has a range of 12 handles or it has a range of 40 handles like it did or actually more than that, back in October of 2008. If I show you a profile graph of 2008, profile graphs, individual days, and take the scale off and show you a profile graph today, you can't tell the difference. So the auction process adjusts naturally to volatility. That's just one example of the robustness of it. Okay, so what we want to do, the simplest uses, and I think these are uses that, regardless of how you trade, I think you can find useful. You want to use the profile graph to identify the migration of value. Which way is the market trading? Which way is it leaning? Is it moving higher? Is it moving lower? Is it just going sideways? You can look at a profile graph, and that's one of the things that the profile graph does really, really well. If you're looking at bar charts, it's easy to get caught in the noise. The profile graph organizes trade activity in a manner that gives order to what appears to be just a choppy, chaotic process intraday. And I'll show you guys this chart in a few minutes, but one of the things that I like to do, especially trading the stock index futures, is to take a profile, split it out, and make 5-minute profiles. Basically, take each 30-minute period and make it its own profile. And it sort of slows the chop down, and you can see what's going on apart from all the noise that occurs for most of the trading day now. And of course, this then enables you to identify favorable trade location. And favorable trade location is what? It's price away from value. So you're always trying to identify an extreme in the particular time frame you're trading, and that's where you want to be taking trades. If you find yourself in the middle of a range in a given time frame, that there's no edge there, and you've got to stay away from it. There is an inherent positive expectancy in this methodology if you will trade from extremes. Okay, now I'm going to give you a basic trading strategy, and this is something that I use and it's something that I teach. You can make it this simple, truly. Use the profile graph to determine the market condition. In other words, is this market trending or is it in balance? Is value overlapping, or do I see a migration of the high volume nodes or the value areas that most of you think of what I refer to as a high volume node? Most market profile traders call a value area. Is that stair-stepping higher? Is it stair-stepping lower? Is it overlapping? And once you've determined that, if you can determine a definitive migration of value, you want to favor trades in that direction, and then use the smaller degree auctions for favorable entry. So you would be taking responsive trades, you'd be fading the extremes at balance areas, and then in a larger degree migration of value, you want to be looking for that initiative trade, because there is a huge inherent edge in catching initiative trades of multiple time frame degree. For instance, today, everybody's been waiting with bated breath for the S&P to finally break out and take out its all-time high. And the market was a chop fest all day long, but if you look on a profile graph, there's a persistent migration of value higher all day. And then finally, at the end of the day, we got that spike up into the new high. Now, the other thing about that, I'll mention, this under auction market concepts should be the beginning of an initiative move. Now, everybody in the world is calling for the grand supercycle Armageddon top here. But if you are an auction market trader and you're disciplined, unless you have a signal and at least some smaller degree time frame that value is beginning to move lower, you have to give the benefit of the doubt to the initiative break. And the initiative break today in the S&P is up. None of the other indices now. It's you can talk about the divergences, and I'm well aware of all of that stuff. The Russell cash didn't take out its high today. Well, maybe it will on Monday. But unless the market itself begins to take out these lower key reference areas that are formed through this auction process, the trend of the market is higher. You can argue with it. You can wish it wasn't so, but people have been trying to predict the top of this market for the past 4 years. I think predicting is the antithesis. It's a killer if you're a trader. You want to be objective, and this is the world's greatest reality check, to use auction market concepts and then the visual of the profile graph. It's either moving higher or it's not. And when a market changes trend, you will see clearly the migration of value lower, and the changes in trend start at the lower degree time frames. So it's, if you want to know when the market is going to top out, look at, it's got to take out today's low. It's that simple. That would be your first objective signal. Now, when I'm looking at a market or I'm looking at ideas to trade, I'm always favoring the side of the migration of value. If value is moving lower, I call these high volume nodes. What I do with my profile, I don't use the value area. I don't use an initial balance area. I have defined the high volume node as it's 30% of the activity. And the value area is 70%. It's too nebulous. It's not as helpful. I have found, and there's nothing magic about 30%. I haven't done any sort of rigorous testing. But if you experiment with it yourselves, I find that this is much more helpful and defining than using the traditional market profile value area. Now, this is the Euro Cable Forex Cross as a contract, but it could be anything. It could be corn. It could be, the Swiss franc. It could be anything. But what we have here is a migration of value lower. I can see that because the high volume nodes in these structures are clearly migrating lower. Now, these are individual auction sessions, This is a multi-session balance area here. Now, when I find a market that is in balance, balance is one of two market phases. You have balance and imbalance, and there's a constant transition in all degrees of time from one phase into the next. So when you're in a balance area of several sessions, I begin to look for that initiative trade. And my working assumption is that it's going to be lower. I'm going to assume this market is going to break lower until these levels, these high volume nodes, begin to be taken out to the upside. It's real simple. Now, when I have a structure like this, I'll take it and I'll split it out into its component parts. And actually what I've done here, this is an individual session, and I have split it out. I use the profile graph in a dynamic way. So if I have an auction like this, and it's a mature auction, this doesn't give me as much information. I mean, it does. It tells me that it's a mature structure. I know that this is my general gross lean up here, but I want to drill down into this because I trade market condition, and the market condition I'm looking for in a structure like this, I'm looking for signals of that initiative trade, that the market is beginning to trend and potentially, hopefully, take this level out to the downside. So then what I'll do, I'll go to this view, and then I'll go even further inside. And in this particular instance, you can see this is one session. This session is an auction, but it is similar to what was initially labeled a double distribution type of day. You had an auction up here. You had your Gaussian shape. You had your high volume node here, and then the market became initiative here. Now, I use, in a situation like this, I'll be looking at a profile chart, but I'll also look at bar charts because there are times when a bar chart will give you faster information and better information about what the auction is doing than a profile chart. A chart is just a tool for me to identify what's going on in the auction process. And if I can see some conviction forming on a shorter-term chart, this is a 30-minute profile chart. So if I'm looking at a 30-minute bar chart and a 5-minute bar chart, and I start to see conviction on a 5-minute bar chart with wide-range bars, that's a signal. That's a trade signal for me. And I already know I'm biased to the short side of this market because of the larger degree migration of value lower. So I'll take that trade. And then I also know that because I have this conviction, it provides my lean. If I'm short in here or anywhere in here, I don't want this market to trade back up into this conviction. Now, these aren't single prints, but the initial concept of single prints was one of conviction. The market was trending. And those become important key reference areas going forward. And I don't want to get too much into the minutia of the semantics of market profile and what was accurate about it and what wasn't. But single prints are an example of basically what was a chronological coincidence. And what you're looking for is conviction. You're looking for the market to be moving. And when a market is moving now, there's only one party in the market that can move a market and that can sustain that move, and that's the bigger money. You know, back in the early days of market profile, you were trying to figure out, you know, is this a commercial, hedgers, public, floor, all this stuff, the other. To me, there are two categories of traders. There's big money, and then there's everybody else. And even now, a lot of the big money is sitting there, high-frequency trading, churning things. I'm interested when the market is moving directionally, and it has become one-sided. And when I find a situation like this, I know that that is a condition in which that one-sided market is more likely to develop than some other time. And I'll begin looking for it on, again, using bar charts because I can get a quicker view, a quicker read on the auction process, and then I want to get on board and ride it, and hopefully value continues to migrate lower. Now, this is another example of parsing out the individual auction, and it's another example of how I use the profile graph. I will take an individual day, and I will split it out. Now, basically what this is the 30-minute bar chart, right? And so you can see you had an auction that formed up here. Now, because this is a robust process, meaning you have the same auction processes in effect in all degrees of time all the time, just as these 4 sessions were a balance area, this is a balance area, and just as I'm looking for a break out of this balance area, I'm looking for a break out of this balance area. So this is the concept I alluded to earlier of identifying the smaller degree auction, where I have the risk of the smaller degree auction, but the potential return of a much larger structure. So if I'm trading this structure and I'm leaning to the downside of this market and I'm trading on this day, then I want to be selling up in here or selling this break against this level because of my bias is down because of the migration of value. I'm looking for the initiative move because we've had 3 or 4 sessions in a row in the same range. I'm expecting the market to move initiatively. So all my trade decisions are consistent across time frames, and it helps me determine, for one thing, it helps me to find markets to trade, and it also helps me to determine, all right, here's the trend of the market. I'm eliminating buying it or selling it. I'm only going to buy it if value is moving higher. I'm only going to sell it if value is moving lower. I am not in here trading both sides of a range if a market is in a condition where it's likely to move sharply. And I know that up to this point in time, the larger degree migration of value is to the downside. I default and defer to the market itself.
Excuse me, Tom. I think you're using a pointer, but we're not seeing it. So if you could.
Oh, I'm sorry. Yes, that's right. I forgot. Hold on. Let me.
Thank you. Mm-hmm.
Thank you. Okay. Now, all right. You see. Thank you. I apologize, guys.
Yes.
So this is. This structure, this is a large auction here. This is a smaller degree auction. So I want to use the smaller degree auction here. It gives me the opportunity for that asymmetrical trade where I'm risking X to make a multiple of X. I don't trade 1-to-1. I think it's a huge mistake trying to risk 1 to make 1. Or even worse, I mean, you see a lot of nonsense. I'm sure you guys see it. Risking 6 ticks to make 3 ticks. It's nonsensical. You'll go broke doing that. It can't be done. So the edge in using this methodology is viewing the auction process and identifying the smaller auctions that are lining up, and the break of which is an early entry into the break of a larger degree auction. That is the inherent positive expectancy of developing a trade model or a trade plan using this concept. And again, you can trade any market using this basic idea that I'm outlining here. I'm going to have to get rid of this. All right, now. Okay, let me get my pointer back, guys. Okay, this was a chart. Now, I put these slides together Thursday week ago, Thursday, March the 20th. And at that point in time, the Russell was trading in a developing balance area. And when I made this chart, we were trading right in the middle of this larger structure. Pardon me. And I was hopeful that I'd be able to come in today and show you how that auction had transpired. So let me go to my screen now. I'm going to go up here. And we'll stop this for just a minute. Okay, now this is the Russell. Now, this is where we were last week, and this is the auction that transpired over the week. Now, when I'm trading a contract, the first thing I do is look at it. It doesn't matter what it is. This could be the Euro cable cross. It could be anything. This market is clearly, it's in balance. So it's basically random between these two extremes. So if I'm trading this market, I want to be trading up in here or down here, because if I'm trading in here, it's a random chop fest, and that's especially true in the stock index futures. So what I'm going to do to identify, get a better read on what's going on, I'll drag all of these individual day sessions over, and I begin to see this Gaussian-looking shape that we were so familiar with from a profile perspective. And I'll move this over. And I'm sure you guys are aware, the last 2 or 3 days we've had sort of Mr. Toad's wild ride in the stock index futures, where we basically traded and tested the range, and then we came in the Globex. This is the Globex session. This is yesterday's day session, and this was a very positive event. Now, when a market gets to this point, especially the stock index futures, after 3 or 4 days, frankly, in the stock index futures, I start looking for the initiative trade, much less one that's traded 7 or 8 or 9 days like this one. So I begin to become very disciplined and oriented to catching an initiative move and cognizant of the migration of value in the smaller degree time frames, because it's increasingly likely the initiative trade is going to occur. So, you know, we had good yesterday. You know, we had the market basically bottomed in the first half hour, the first 40 minutes in the Russell, and then closed on its high. And then Globex traded around the area of value here. It's uncanny how this auction process plays out and how these high volume nodes, these areas of value, are fulcrums for the market prior to initiative moves. Then we came in this morning, we traded down to the low extreme in the early trading, and then basically went into a chop fest all day long. Now, we have a situation where, look what happens. We have not broken out of this. We're still looking for the initiative trade. But when I see a market like this, if this market now, it should trade initiatively, and I'm basing that not just on, it should trade initiatively higher. I'm giving it the benefit of the doubt. This market is unlikely to just stay in this narrow range between this high here. Wait a minute. Well, you can see my cursor, right? And this low. So I'm willing to take the trade here, whether it breaks this to the downside or it breaks this to the upside, because there is the clock is ticking on, in this particular contract, on the next directional move. And my expectation would be, if this level is taking out, then I would be my target would be below the low of this structure. And if this is taken out, it's an initiative trade. An initiative trade has an inherent edge. I don't know where it's going to go because there's nothing above it. You know, if it does take this out, you know, you have the S&P that I think the cash closed at all-time highs today, and I think we have I don't think it took out the print highs, so we have that in front of us. But this is a wonderful contract to trade now on Monday because of the market condition it's in. It's in a market state that is conducive to a sharp move. And most of the time, the market is, as you guys know, especially the stock index futures, is sort of a chop fest. Today was until the very end of the day. So this is sort of the segue from last Thursday. We still haven't broken out. But the good news about it is that the market continues to define itself and paint itself further and further into a corner, and we're looking for that sharp move. So if this market moves above here on Monday, it should not take out whatever the Globex low is at that point in time that we have Sunday night into the day session. And then if the market is trading below this level, I will be looking for shorts aggressively unless it turns around and takes out a volume node to the upside. And that's how I trade this. you could fine-tune it, but I'm basically using the auction to identify the larger degree trend that I'm of the contract that I'm trading. I try to find contracts that are more likely than others to move sharply in a larger degree time frame than one I'm trading. So it gives me an inherent edge in I'll catch bigger moves that way. And that's the basis of how I use this concept.
Okay, Tom, I think, is that our cue then? You'd like to go ahead and open it up for questions then?
I believe so. I think we're...
Okay, that's great. We have, appreciate this again, we have a couple of questions in, one from AJ on how do you feel that Stoudemire, Jones, and Dalton progressed market profile from the original concepts?
I think that Stoudemire and Don Jones are the ones that have progressed it. I think that Dalton is basically, I give him credit for making it very popular, but to me, Dalton's work is basically a rendition of Don Jones and Stoudemire's work. And Don Jones is the one that explicitly came out and said, look, you can't take a profile graph, an individual profile session, and make a prediction. You can't do it. There were a lot of concepts that, because Don's a scientist, he still programs to this day, and he would take some of these ideas that were positive, that were very popular when Dalton first wrote his book, and some of the ideas that Stoudemire had, and said, look, guys, there's no edge here. So Don gets a lot of credit for developing the concept of, and he calls it a meta profile, which is basically the composite profile of a larger degree auction. And he has proven through rigorous hypothesis that there is an inherent edge in taking the initiative trade. Now, Stoudemire has continued to develop the concept along the auction lines, and quite frankly, he's doing something similar to what I'm showing you now. He is looking at the migration of value, and he's favoring trades in the larger degree trend, and he's breaking out the smaller degree auctions. Now, he's developing software and that does that, but that's the basic concept. But Don Jones was talking about this in 1993, 1994, before Dalton or Stoudemire were explicitly talking about it. Stoudemire's books, I highly recommend, especially his early works. But it's not, it's fascinating to look at the evolution of his thought process about market profile, but it's the stuff between the lines that is just really, really good in my mind. So most of my work, actually all of my work, is based on, one way or another, the concepts of Stoudemire and Don Jones.
Okay, we have the second question, and this is coming from a spreader. So is it possible to determine the percentage odds of when a market condition may move from balance to imbalance intraday on a synthetic spread?
The short answer is yes, but the holy grail of this is, everybody always wants to figure out, well, when is this balance area mature and when is it going to break? Is there a formula here? Is there a certain TPO count that tips the odds in the favor of the initiative trade? Nobody's been able to do it, and I think that's good news, frankly, because if you could do it, you could program it, and it would degrade the edge. But there is an inherent edge. If you're trading a market, and I'm a discretionary trader. I'm a rules-based discretionary trader, and I wish I could give you some hard numbers about, okay, when you have a TPO count of 80 over so many days, you got to start looking for the initiative trade. What I do, it's just like I showed you on the Russell chart. When a market begins to have that fat Gaussian shape of 4 or 5 days, at that point in time, I become hypersensitive to the smaller degree auctions and the migration of value there. I'm still trading from the extremes of those smaller degree auctions. So even if the initiative move doesn't happen, I'm not going to get hurt, and I'm still going to make money. I'm favoring trades in the direction of the larger degree trend. And if I think that, if there is a balance area that forms, what I refer to as a balance area, that forms over 4 or 5 days, and the larger degree migration of value over weeks has been up, I'm buying. I'm a buyer, and I'm trying to identify areas to buy. The areas to buy for me then are, I'll be a responsive trader. I'll buy the low extreme of a developing balance area. I'll buy the low extreme of, the day's range, things like that. So there are ways to define your edge so that you put yourself in front of that initiative situation when it occurs. But to give you a probability or some set of statistics, I can't do it, and to my knowledge, nobody can.
Okay, thank you. We have 2 last questions that we have time for at this point. If you have any attendees have any other questions for Tom, you can reach him at tom@alexandertrading.com. So one question is, what other studies do you use with Profile for perspective or confirmation, such as ADX or any oscillators for extended conditions?
I am anti-oscillator. I think oscillators have killed more traders than anything that's ever been invented. And an ADX, I think, purports to be a trend indicator. And I think I can look at a chart and do a better job of predicting when a market is going to move, is more likely than random to move sharply than anybody using an ADX. And you can too. It's a matter of perspective. It's a matter of training yourself to view the market. It's a specific worldview of how a market works, and it's consistent. It is as consistent and as objective as a discretionary trading approach can be. So I don't use indicators. I know people that do, and I know people that use a lot of volume studies, which I think can be helpful because it's giving you information directly derived from the market about the market itself. But you have to be careful with volume too, because most volume is not directional, contrary to popular belief, especially nowadays with high frequency trading. So you can't just look at a bar chart with volume under it and divine special meaning from parsing out the bid-ask volume.
Okay. Our final question, the CME apparently offers a book on this topic. Do you know if Peter Stottlemyre wrote that also?
You're talking about the CBOT manual?
No, the question came in saying the CME apparently must have written some material available at their website.
I'm not familiar with it,
okay.
Tom. I can't speak to it.
Okay, finally, all of the attendees will receive in an email a link to the recorded session. It'll be posted sometime on Monday. And that concludes our webinar at this time, so I want to say a special thanks for Tom, and thank you all attendees for coming to this. And check back with the events page at news.cqg.com for future webinars.
Thank you, guys. Tom, thank you. Ami, thank you. You're in the background there, I know.
Okay. Thanks, everyone.